Hi guys. Okay, so we're going to go through some of these homework assignments from Chapter 2. And the ones that I'm interested in, I think it starts around homework assignment number 6 here in Connect. And I want to go through these with you because it gives us a good view of how we would use a general ledger software to go through the process of recording transactions in the journal, then posting them to the ledger, and then taking that information from the ledger. Trial balance would just be sort of a quick glance to see what the financials are going to look like, but I'm interested for us to be able to know that once we have gone from the general journal to record the transaction, posted it in the general ledger, that then we would go ahead and see how that impacts balance sheet, income statement, statement of retained earnings. This financial statement impact is just something McGraw-Hill put here that they thought was a good exercise. I don't care for it. So I'm focusing right here. Okay, can we see how when we post a ledger that impacts our balance sheet, income statement, statement of retained earnings? We also have a statement of cash flows, but we're not considering that at this point. We'll get to that. We'll get towards the end of the class actually here and see how that statement works and spend a quick time with that later. But let's go ahead. And we're past the instructions here, so let's just go to our general journal, and we're going to go ahead and record these transactions as they occur here. And these are the different dates. I think it goes all the way up from December 1st through December 16th in this example. And this first one, they tell us that they had some cash and they issued the common stock for the cash, probably starting the company out here. So let's go ahead and do the entry, and I have to remember to pause. So let you pause the recording and go ahead and try this entry on your own. Cash for common stock. Okay, I'm assuming you paused and had a chance to try that on your own. And let's just go ahead, and since it's cash that we are dealing with here, we're going to enter the cash. Okay. We're going to receive cash of $30,000 in this transaction. Cash is an asset. To increase it, we debit it. The credit is going to be to, and hopefully you got this, that it's common stock. Okay, and that is a credit of $30,000. Okay, because we're issuing stock. That's stockholders' equity. To increase stockholders' equity, we credit it. And then I'm going to go ahead, and I have to remember to record the entry. Sometimes I forget to hit that key. I have to record it. And what do you think? We look at the general ledger. We right now have only 2 accounts that we posted to. There's our debit to cash, our credit to common stock. Which financial statement do you think it's going to impact? Income statement, retained earnings, balance sheet, right? Not the income statement. Okay, when you look at the income statement, everything's still zero. Not the statement of retained earnings. We don't have retained earnings yet. We haven't made any income yet on this. How about the balance sheet? Yep, impacts the balance sheet. We have our cash. We have our common stock. Okay, somebody asked me at the end of class, does every transaction have to affect both the balance sheet and the income statement? The answer is no, right? We could have just a purely balance sheet effect journal entry here, which you can see from this issuance of common stock. Okay, so we get that one done. Let's go ahead. Let's go to the next transaction and just hit view transaction list here. Hit that second one now that I guess is supposed to be on December 2nd, and we go ahead and we start with that one. And so it happens, they paid $2,500 cash for supplies. Okay, you might want to pause and try that one on your own. Okay, and then let's just take a look at that. And since we're purchasing supplies is an asset, right? It has future economic benefit. We'll be able to use those supplies in the future. Okay, and then we're going to go ahead and they tell us it's $2,500 for supplies. So I want to enter that, and they tell us that they did what? They paid cash for those supplies. So I'm going to go ahead, enter my cash, credit my cash for $2,500. I have to always remember to hit that record the entry button. And what do you think? Okay, when we look in our ledger. We post to our ledger. There's our posting. Our cash has come down, but our supplies have come up, right? Purely assets. We have traded one asset for the other. So there is only a balance sheet impact. Okay, there's our assets equal liabilities. We're staying in balance there. Nothing still on the income statement. There's been no income statement impact from these first couple of transactions. They've entirely affected the balance sheet, right? Okay, so let's go ahead then and let's try another one. Let's go to number 3 here. And now they pay $26,000 for equipment. So if I'm purchasing equipment, whoops, gotta pause, let you go ahead and try that one. Okay, so how'd you do? If we're purchasing equipment, I'm going to go ahead and I'm going to debit my equipment, right? Equipment is an asset. I have to debit it, $26,000. Okay, and I've done what in exchange? I have given up some cash, which is also an asset. Okay, so one asset, equipment went up, another asset, cash has come down, right? There's my cash. So if I want to decrease my asset cash, I credit it. Okay, and I'm going to record that entry. And what do you think? Let's take a peek at our income statement. No, still nothing on the income statement. That was purely a balance sheet effect, and that we did what? We've purchased now some equipment. Our cash is getting pretty low, right? Because we used up some on supplies, some on equipment. But notice those are assets. We've exchanged for cash for equipment, supplies. And notice our assets equal stockholders' equity is still in balance. Okay? And another takeaway that you should be having right now is what? How much cleaner and easier this is than the process we went through in class together. We had to use that, and even that was an Excel spreadsheet. Imagine doing it with paper and pencil, but we had to go through and record those transactions. And then finally, when I pulled the financial statements, I was writing on the edge of that spreadsheet and stuff. Much more tedious process than this, right? Okay. All right, good. So let's go ahead and let's try the next transaction. Let's try number 4 here. And we take a look, and this one tells us now that they purchased supplies on credit. Okay, now we better purchase on credit because we're out of cash. And they tell us on credit, that means that we are going to have a liability because we're using our credit card. Think of it that way, to purchase this, and we're going to have to pay the person in 30 days or so. Even if they don't issue us a credit card, if they give us an account, that's going to be, considered a liability. We're going to have a bill, right? We're going to have to pay this person back. So what happens? Well, we still got supplies, didn't we? Even though we're going to pay this person later. So supplies is still an asset account. So we go ahead and we debit supplies, and we debit supplies for $7,100. Okay. Oops. I hope I gave you enough time to pause on that. Sorry. Okay, and then what? Then we go ahead and we got it on credit. Usually we call credit accounts payable. Let's see if that's what they called it. Accounts. Yeah, there's my accounts payable. Okay, so I go ahead and I have to credit that for $7,100. Sorry if I didn't give you enough time on this one. I have to remember to do that. I get so excited about accounting, sometimes I can't wait to make the journal entry. I go ahead and I record the entry. Okay, and what do you think? Do I have an income statement account now because I did get that on credit? No, again, entirely balance sheet now. For every one of these first 4 transactions, we've gone to the balance sheet for these, right? And so now, notice that we have what? We have a liability that has come up. So even though our asset for our supplies came up, we also got a bill that we had to pay as well. And so notice that we are at $7,100 here for our liabilities, and notice our stockholders' equity plus our common stock still balances, right? Liabilities, our supplies went up for $7,100, but our liabilities went up for $7,100. It might help to look at, I think it's a good idea for us to look at the general ledger on that one. And you can see here how our supplies went up $7,100 and our liabilities went up $7,100. Supplies is an asset. Accounts payable is a bill. Pay a bill is a liability, and so our equation stayed in balance. Still, nothing has happened on the income statement, right? We're looking for revenues and expenses when it's going to impact our income statement. Okay, so back to our general journal. Let's go back to our transaction list. Let's do number 5 this time. Okay, and let's go ahead and let's take a look at this one. And they tell us they provided consulting services and immediately collected cash. Okay, now I'm going to do something a little different this time. I'm going to go ahead and I'm going to just deal with my cash first. Okay, and the reason I'm doing this is this is not the conventional way to do these, but I'm going to do it this way because I want you to realize that you don't have to, from your thought process, go through and first do the debit and the credit. If you know that the credit is to cash for $4,200 because we spent cash is an asset, and we want to decrease it, we credit it, and I think you're starting to understand cash now, then you can sort of ponder the debit once you've sort of written down the cash. And sometimes it just helps me to do it that way because then I can figure out the other side of the entry here. If we have, oops, and I bet you I've confused you now, haven't I? Okay. Cash was being received. Okay, so hopefully you're getting some comic relief from that. If that's the case, if cash has been received, then what? Then I should have debited cash. Sorry to confuse you. Just testing you here. I should have debited cash. Cash was received. So I debit the cash. And what? I know I still have to have a credit for $4,200, but I should have been crediting cash. I should have been crediting what? I should have been crediting the service revenue. Okay, let me see if they give me service revenue here. Maybe not. They say for consulting services. See if I can find my revenue account. There, no, that's rental revenue. Here we go. Consulting revenue. Consulting revenue. That's how they wanted to classify that. I'm a consultant, so it's consulting revenue. So I credit the revenue to increase revenue. Remember, to increase my revenue, I credit it, right? And so there's my debit and my credit. And I'm going to go ahead and record that entry. And when I record that entry, I take a look up here, and I have my general journal. I just recorded that. My ledgers, of course, are going to show that I now have decreased my... Boy, I'm hell-bent on decreasing the cash for this transaction. I am going to debit my cash to increase it, $5,700, and my what? My revenue is now up. I debited the cash $4,200. My revenue is up $4,200. Okay, easy for me to say. Now, the question here is, what financial statements got impacted? And I'm thinking, what income statement now for my revenue? And of course, I'm going to get a slow internet connection here to add insult to injury. Okay, income statement. There it is. Anytime you want to bring me the income statement would be fine. McGraw-Hill, John's Internet. Okay, and there's my revenue. Now I don't have any expenses yet, so I'm showing a net income of $4,200. The cash increase, of course, impacted my balance sheet. So my cash went from the earlier balance that it was to now, what was it, $5,700 for the cash. Okay, and that's just reflecting. Now, if I were to look at my ledger, where we saw that I had $1,500 cash, and now I've got $5,700 because I've provided these consulting services. Now here, the statement of retained earnings is going to start to show now the impact of this income now that I have. showing me net income of $4,200. I haven't recorded any expenses yet. In practice, we are going to, and in particular, we've already done this in that little spreadsheet exercise. We would have had to have done closing entries to debit the revenues and credit the income summary, and then we would have credited our expenses, debited the income summary, and closed out income summary to retained earnings. They didn't show all that here. They're just having it post straight over to retained earnings, but we would want to go through a closing process that's not contemplated in any of these general ledger exercises that we see in Connect. Okay, all right, good. So let's go ahead then and continue on with our transaction list, and now we're ready to do transaction number 5. Okay, and we pay $1,000 cash for December rent. Okay, so let's try what I was trying to show you in that previous one, where I'm going to enter the credit to cash first. Okay, now again, the conventional approach is to put your debits first, but since I'm paying cash, cash is an asset, that's going to be $1,000 per the facts of the transaction. And what? I have a rent. I'm paying my rent. So what's happening? I have used my cash and I have an expense. I have expired the benefit here. Okay, so it's an expense, and I'm going to just go ahead and type in rent. I'm thinking maybe they have rent expense here. Okay, rental revenue would be if I rented out my building or something. This is rent expense. My future economic benefit has expired here, and that you got to pay the rent at the end of the month, right? I go ahead and I record that entry. Okay, and what do you think in terms of the impact? Where did this impact? What do you think? Let's look at the general ledger. Let's just see what's happened to my cash. My cash has come down. Remember, it was $5,700. Now it's $1,000. So my cash has come down. And what's happened? I have incurred an expense. My rent expense. Where do you think rent expense is going to show up? Rent expense is going to show up on the income statement now. And I have revenue for the consulting fees, I think of $4,200, and now I'm going to have an expense of $1,000. Drum roll, please, as this thing gets over to the income statement, and we have what? There we go. We have our consulting revenue, our rent expense. There's our net income right now at $3,200. Okay, and so when we look at the statement of retained earnings, again, we're sort of pulling the statement of retained earnings from what we're seeing on the income statement. We would have to make closing entries to get this into retained earnings when it finally shows up on the balance sheet, but there's the net income there sitting in our statement of retained earnings. Okay, so let's go ahead and we continue on. Let's go back to the general ledger. And I think I'm forgetting to give you guys enough time to record these. I mean, not our general ledger, but our general journal. Let's view the transaction list. Let's go ahead and let's do this one on December 7th, the day that will live in infamy, right? And we go ahead and we look at December 7th, and we're going to want to record this one, which is $700 cash for an employee's salary. Okay, so I'll give you a second to think about that, John. I keep forgetting to give you a little second. Okay, you can pause the recording. Okay, and let's go ahead and let's take a look at that, and I'm going to type in salary expense. There it is, salary expense. Okay, and you can find it by the drop down, and you can see that the system allows you to search for the account you're looking for. But salary expense, right? Because I have to pay that employee's salary. To increase an expense, I debit it. And I'm paying cash, so clearly I have to what? I think you're starting to get the hang of cash by now. Cash is an asset, so I'm going to credit it for $700. Okay. So now I've gone ahead and I have paid that $700 cash. Record the entry. Okay, come back. Let's see, general ledger. there's that $700 reduction in cash, my asset, okay? And there's my $700 increase in my expenses now for $700 now salary expense. Now, notice what cash is on the balance sheet. Cash is still showing at $4,000. Okay, if I can get my cash to show up here, my balance sheet to show up. Okay, there they go. Scared me for a minute. I thought they were going to tell me McGraw-Hill wasn't responding. But there's my cash, $4,000 on the balance sheet. Notice the balance sheet still balances. And again, the way this software is working, it's showing us the retained earnings balance right here on the balance sheet. Again, we would get to the balance in retained earnings through a set of closing journal entries because we really have not made journal entries to impact retained earnings. Instead, they're just taking what they're pulling from the calculation of retained earnings here, picking up the net income from the income statement and just plugging it into retained earnings. On the statement of retained earnings, we'd have to do our closing journal entries to actually get it into the account of retained earnings. And we talked about our closing journal entries last time a little bit. But you can see here's our revenues and there's our expenses now, both the salaries and the rent, to give us a net income of $2,500. Okay? All right, good. So let's go ahead and let's look back at our journal. Okay, and let's do our next transaction. Okay, and let's take a look at this number 8 here, where we are going to do what? Let's read in that window there. December 8th, another consulting service costs $1,600, and we also are going to rent out some of our facilities for $300, and the customer is billed $1,900 for these services. Okay, so what do you think about this one? This one's a little different from what we've had before. I'll give you a second to think about it. Might want to pause. Okay, let's go ahead and let's take a look at this one. And we're going to do what? Did you get it right? We have to have an accounts receivable, right? This is a receivable. We're going to receive this money in the future. So the person hasn't paid us yet, but they're going to pay us. So we have a future economic benefit. We have a receivable. So we debit our asset, $1,900. Okay, now how about our other side of this transaction? How about our credits? Well, we provided consulting services, and I know now that they call that consulting revenue for $1,600. That's the consulting revenue part of that. But I also am having what they say was rent. We rented out the building. So we have rent revenue as well. So notice we have a couple different revenue accounts, and some of the examples that I was doing in class with you, I went ahead and I combined everything into one big revenue account, but we have line items on our income statement, and so we'd want to show the different sources of revenue. If we were going to have a different line item, we need a different account here, and so that's what we did. We went ahead and let's just take a quick look at the income statement that impacted. Okay, I just want to look at the income statement, please. Okay, and I go ahead and I take a look at the income statement, and there I have now what? Well, I just recorded my rental revenue. Did I forget to record the transaction? I think I did. Sometimes I forget to hit that button, and you see what happens if you don't hit the button, record the transaction, it doesn't record it. Okay, so a little lesson in how to use the software. So let's try that one again. Get a little extra practice with that one, right? Because your dumb teacher didn't hit the record the entry. So accounts receivable, right? The $1,900, they're going to pay us later. That's an asset. Okay, and then what? Then I have to go ahead and I have consulting revenue. Isn't this fun? You get a repeat for free here. for 1,600. Enter that, and what? And I had rental revenue for, they told us that was 300, right? Okay. Hit return, hit record entry, John, or it won't go in. Okay, and then we go ahead and let's try that again. And what did we look at first? The income statement we were trying to just see. There it is. The rental revenue now is there. Okay, and when we look at the balance sheet, we have now this asset for what? For, where'd you go? Okay, I know I hit receivable, didn't I? Must not have. Must have made a mistake and not hit receivables. Okay, I guess I made another mistake on this one. I'm having a little trouble with this one. So let's go back to the general journal. Let's look at that transaction again. Debit accounts receivable 1,900. Okay. Let's take a look at the general ledger. There's my accounts receivable, 1,900. Let's look at the balance sheet. Maybe it's a little late here and I'm missing it. Okay. Well, dear McGraw-Hill, you're not doing this right. Did I not hit accounts receivable? General journal. There's a transaction, debit accounts receivable, 1,900. That's on the balance sheet. There's my revenue. Aren't we having fun with this? Okay. There's my income statement for my consulting revenue. Now 5,800, the 16 plus what I had in there before. If I look at my ledger, consulting revenue coming down here. There's that 1,600 to bring it up to 58. And look at my balance sheet. Okay. Well, that at least explains why my balance sheet isn't balancing, because they're not showing me the account receivable here. So we clearly have a glitch in the software that it's not showing me. It should show account receivable as an asset here. And if it had shown me accounts receivable as an asset, this would balance, right? I have 1,900 more in here. So I'm going to pause and I'm going to look at this for a second. I'll be right back with you. Okay, guys, I'm picking back up, and I can't explain to you why the software is not working here properly for us. I have no control over that. I'm thinking about calling McGraw-Hill and yelling at them, but I have a feeling they wouldn't be able to explain it to us either. But just looking, here's my accounts receivable, which is an asset. I debited that. I credited my consulting revenue for 1,300. I credited my rental revenue because in this transaction, remember, there was also some property there. They were renting out their building. Okay, consulting service 1,600, rent for 300, and we billed the customer for 1,900. So there's my accounts receivable, 1,900. There's my consulting revenue for the 16. There's my rental revenue for the 300. Now, when you look into the general ledger, they show us accounts receivable 1,900. That's great. Okay, and then they show us down in the revenue, we have rental revenue for 3, and we have our consulting revenue, which went ahead and increased for 1,600, so it's up to 5,800. And when I look at the income statement, I'm satisfied that that transaction was properly recorded, because there's my consulting revenue, now 5,800, and the 300. So that's reflecting the credits to revenue for that. Okay, 5,800 is for the revenue. again, just looking back at my ledgers, and this is how an accountant would go through and see that things were being done properly, and that this is the point of these ledgers. I can see my transactions there. The 1600 brought it up to 58, right? My rent revenue's 300, and I'm seeing that in the income statement. 58, 300. I'm seeing my net income is 4,400. So I look at my retained earnings. That's showing up at 4,400. I look at my balance sheet now, and there's my retained earnings for 4,400. So they got the revenue side of that. I cannot tell you why the system didn't put accounts receivable right here. Accounts receivable is an asset. They should be having 1,900, and if they did, the balance sheet would balance to be 41,500. So I'm going to call McGraw-Hill and tell them, they really should do a better job to make sure this stuff is working properly, because it gets a little hard to teach new accountants like yourself things when we have a software that's decided not to work on this, okay? But let's go ahead. We can still continue with this and continue to look at the transaction list and continue to record these transactions, although frankly it's destroying the beauty of this exercise a little bit when we go ahead and drop a journal entry. But now they go ahead and they tell us that they received the 1,900 on this receivable, which is interesting. Maybe that's why it's already not showing up and they just jumped the gun on us, and that we are going to credit, well, let's debit the cash first, okay? So we're going to receive cash, okay? And they're paying off that 1,900 receivable. So we're going to go ahead and we're going to debit the cash, 1,900. We're going to credit the accounts receivable, okay? And when we credit the accounts receivable for 1,900, like that, and we record the entry, okay, and we take a look now at the ledgers, post to the ledger, and the accounts receivable indeed is 0 now, and now I agree with the balance sheet showing 0 for accounts receivable, and now the balance sheet balances again because the cash came up correctly. They're showing the new balance in cash here, which went from, just looking at the ledgers here, went from where it was at 4,000 and now it's up to 5,900. So I show my correct increase in cash, and I just decreased the receivable. So entirely a balance sheet account, but a balance sheet transaction. But I got to tell you, they ruined the beauty of the example here, and that we should have seen the accounts receivables here at 1,900 and the cash here at 4,000, and I think the cash was 4,000 before we recorded that last entry, and then you would have seen now accounts receivable is 0, and we have the 5,900 cash, sort of the way you can more clearly see in the ledgers here. But anyway, disappointing that they messed that up. I think it was just because they couldn't do in the software for some stupid reason to have accounts receivable showing on the balance sheet and then not showing on the balance sheet, so they just chose to not have it there for a second, which maybe they're not anticipating some crazy guy like me sitting here going through and tracking each transaction through to the balance sheet and the income statement is probably what happened. Anyway, okay, so let's go ahead and let's do that next transaction. Okay, go back to the general ledger, and let's do the next transaction. Okay, now we're doing one that is showing up on the 10th. Okay, a few more of these to go for this particular homework assignment, and we take a look, and they tell us that they pay $900 cash as partial payment for the December 4th purchase of the supplies. Now let me see if I can go back and at least look at that December 4th. Good. On December 4th, you can see that they set up the payable for the 7,100. Okay, and if we were looking at our ledger And if the guy said, "Hey, are you going to pay me that money you owe me?" we would say, "What money we owe you?" "Oh, that's right. We owe you $7,100 on accounts payable." I'll tell you what, we're a little tapped out this month. Is it okay if we pay you? And what did they tell us how much we were paying? Is it okay if we pay you now the $900 cash on that? Okay. Now, we're going to pay him. He says, okay. So we're going to pay him some cash on that. But remember, back on December 4th, we did what? We had gotten the supplies at that point in time. So on December 4th, just to go back, December 4th, we did what? December 4th, we debited the supply asset, and we credited the account payable on December 4th, and now we're simply going to give up some of our cash to pay that bill, to pay that liability, okay? So again, this is entirely going to happen on the balance sheet, so I'm going to go back to my general ledger. Not my ledger, my general journal. I go back to my transaction list, and I was working on this one here. Let me go ahead, and they're going to pay this now. So we go ahead and do what? We debit the account payable, right? It's a liability. We want to decrease it. How much are we paying them? $900. So we just decrease the liability. And we're going to do what? We're going to credit cash, right? Because we're paying the guy cash for that bill. Right? When you pay your bills, you give up your cash. Credit that $900. Okay, we go ahead and record the entry for that. Okay, now where was the impact of that one? Entirely balance sheet, right? So let's look at my balance sheet. Well, a couple of things that I'm learning from this. One, the software is slow, and two, it makes mistakes, or it doesn't show us everything as we go along. But we went ahead. Our cash has come down now, $5,000, but so has our liability. It's now $5,000. Came down $900, and so has our liability come down $900. It was $7,100, but we just paid $900 on that. So that's come down as well, and our balance sheet is still balancing. There was no income statement impact for that at all. Nothing. Okay, nothing changed on the income statement. Remember, the income was $4,400. Nothing has changed because that was simply paying off a bill that we had incurred for our paying a bill when we had purchased the asset supplies earlier. Okay. And so far, we're saying that our supplies haven't been affected, although I have a feeling at some point we're going to use up these supplies, but and have to make an entry for that. But let's just go ahead and let's just take a look again at the transaction list. Let's look at number 11, okay? And we went ahead and we paid a dividend of $200, okay? Now, a little odd to pay a dividend at this stage of the company's life. We just started business and we're paying a dividend already on December 2nd. But if it's a cash dividend, since we're paying cash, okay, we're going to credit cash for $200. Again, I'm going a little bit out of order here. I like to sometimes put my cash in there first because cash is easy for me and I know how that works. And I'm going to debit what? So think about it. Okay, debit dividend. Dividend gets debited for $200. Okay, and record the entry. And they're doing this just so you can see, I think, what financial statements are going to be impacted here for this. We paid a dividend. Now, dividend does what? It gets paid out of retained earnings. So notice my net income is the same. I subtract the dividend out of retained earnings now, and I have this new retained earning balance of $4,200. And we know the cash has been reduced now. Okay, if we look at the balance sheet, our cash went from that 5,000 to 4,800, and our now dividend is showing 4,200. So the balance sheet is still in balance, isn't it? Okay, so dividend has the effect, the bottom line effect of an expense on retained earnings, but we don't show it on the income statement. We show it as a subtract in our retained earnings on our statement of retained earnings. You see it there. It does not show up on the income statement, but it has the same effect on our retained earnings as an expense, in that it reduces our retained earning because we're not retaining that earning anymore. We're paying it out in a dividend. And again, it's a little unrealistic for us to be paying a dividend, after we've been in business for all of 15 days or whatever I'm talking about here, when they did this 11 days, whatever. But they just want to show you how that impacts the statement of retained earnings. Okay. All right, good. Let's go ahead then and let's take a look at the next transaction. Okay, so I'm going to go back to the transaction list for this one. Back to my general journal. Transaction list. Let's take a look at December 12th. Okay, and what is this one? They received $3,000 cash in advance for providing consulting services to a customer. And we had an example of this in that little one that we did in class together, that if somebody comes to me in advance and says, here, John, here's some cash, here's $3,000. Okay, I really like your service. I want to make sure that you're available for me, so take the cash. Well, now I have a liability to this person. I have an unearned revenue that I owe this person. I'm on the hook to them to either give the money back to them or provide the service. So until I provide the service, I cannot take that as a revenue. I have to take it as an unearned consulting revenue. Go ahead and record the entry. Okay, isn't this exciting as we wait for it to... it has recorded. We don't have to wait for it. It's probably done it already. Let's just look quickly at the income statement. Okay, let's start with that. Is that on the income statement? No, it's not. Okay, we're not showing that as revenue yet on the income statement. Notice our net income is still that $4,400 that we had before. Instead, that unearned revenue shows up on the balance sheet as an unearned consulting revenue for $3,000. We haven't provided that service yet. And of course, our cash has come up $7,800. Our liabilities come up $7,800. So my balance sheet is still in balance here, right? Okay, so that affected entirely on the balance sheet. There was no income statement impact for this unearned revenue because I haven't earned that yet. I still have to provide that service. Okay? Okay, good. That's a nice transaction for us to understand. So let's go ahead and let's take a look at the transaction listing again. And let's go ahead and take a look at how many of these more do we have to go? About 4 more of these. Hopefully you've taken a nap at some point in the middle of this video as we've gone through and worked through this homework assignment together. And let's just take a look, and we say that on December 13th, Fast Forward pays $2,400 cash insurance premium for a 24-month insurance policy. Coverage begins on December 1st. Well, geez, we should have purchased this thing a little sooner. That means we went without insurance for about 23 days here. I don't know what kind of business operation we're running here, but anyway, that's okay. We'll go ahead and we're paying for the insurance policy now. So at this point, we're setting up a prepaid insurance for $2,400. Okay, and we're going to do what? We're going to credit our cash for this. Okay, for $2,400. Okay, because we're paying for this insurance policy, $2,400. Okay, and we go ahead and we record the entry for that. Now, we paid this. We have prepaid insurance. That's entirely on the balance sheet. Okay, so there's the prepaid insurance, $2,400, and our cash has come down $2,400. So that's entirely on the balance sheet. Now I'm curious, I don't know how they're going to deal with the fact that by the end of the month, 1 month of that has expired. So let me see if they tell us what to do with that. They do not. Okay, so they're not giving me a clue here as to what to do with that insurance. But I would need to go ahead and accrue 1 month's worth of coverage on that insurance. I see, it's because it doesn't go to December 31st, so maybe that's why they didn't do it. But I'm just telling you that if I'm sitting here with a 24-month policy, okay, I would go ahead with that 24-month policy and just picture, I'm not going to try to find my calculator right now on here, but just picture I would have $2,400 that I've paid for that policy. Is that what they paid for it? Right, and it's a 24-month policy. 2,400 divided by the 24 months is $100 a month. Okay, now what I would do, and I'm just going to go to the general journal now, and I'm just going to record a transaction even though they're not asking for it in one of these. So view transaction list, and I'm just going to go ahead and stick it here for a second. I know this is not what this is asking, but just bear with me. The journal entry that I would make for the 1 month that it has expired, it's $100 a month that expires on that insurance. So let me see, do they have insurance expense in this ledger? Probably not, so I can't debit the insurance expense. Yeah, they do. Okay, so I don't know, maybe they wanted me to set it up this way to begin with, to set up the thing expiring, although it wouldn't have been until December 31st that it would have expired that first month. But I would debit insurance expense $100. That's for that 1 month, right? 24 months, $2,400 is what we paid. That's $100 a month. I would debit insurance expense, and I would credit what? Credit prepaid insurance. Credit that prepaid insurance for $100. Okay, and I'm going to record the entry for that, even though I know that this was not the transaction that they wanted me to record here. But notice what happens. Okay, let's look at my general ledger now. Let's see what they've done for us. We have in the general ledger our there was when we bought the insurance policy for $2,400, our prepaid insurance came up $2,400. I just credited the insurance expense. Credited the prepaid insurance, so it's now $2,300 because I have 23 months to go on that policy. And I would have done what? I would have debited my insurance expense down here. Where are you at? Insurance expense for $100. So now I have this insurance expense of $100. And so if I look now, I'm showing $2,300 because I have 23 months left on that policy at $100 a month, right? And if I look at my income statement is showing me that $100 of that insurance expense has expired. And again, see, they're not showing me the insurance expense over here, guys. It should have shown me insurance expense, should have showed up for $100. The reason they're not showing it here is because the ultimate solution didn't contemplate accruing that insurance expense until December 31st. And in this example, even though they're showing to December 31st, the transactions in the general journal only went up to I think it ends up being the 16th. Okay, so they're not going to provide that for us to show us how that would look. Okay, but I'm just telling you that's something that we're going to get more into in Chapter 3, that we have to make accruals. If we come to the end of the year and a month of insurance has expired, we have to make the journal entry for that. Okay, so let me go back to my journal. Okay, go back to the journal. Well, I guess I am in the journal. Okay, so I'm going to go back to the view transaction list. And I wonder if there's a way that I can fix that one now, where I put in insurance. Let's see. Yeah, I can undo this. Okay, so what I'm going to do now is I'm going to put the correct entry now for this, which is they paid $120 cash for supplies. So I'm going to debit my supplies account. So I'm just reversing now what I put in there a minute ago, because that's not the way the problem was written. I was just showing you what I would do. It was what, 120? Yeah, okay. I'm just fixing now. And I'm going to credit what, cash, right? For 120. Okay, because that's not what I just did, is not the way they wrote the exercise. I was just showing you that we would have had to record the expiring of that insurance. So we just went ahead and we purchased those supplies. We're using up, so we're getting some more supplies now. Okay, all right, good. Then what? Then we come over and let's take a look. I guess they already have us set up on this transaction 15 now, where we're going to pay our utility bill. So what happens? Well, now we have utility expense. And the utility expense is for $305. Right? We got to credit something. What do we credit when we're paying a bill? We credit cash, right? Okay. Now, we paid this expense when we got the utility bill. We hadn't set up a liability for it before we paid it, so it just simply went to the income statement. I don't know, do you want to save this sheet until cancel? Would I not record the transaction here? Okay, and so what happens, there's my, I guess I didn't record the transaction. Go back to the general journal. Must have been dreaming when I thought I recorded that transaction. It is a little late here, so let me go ahead, get to watch me do that one twice now. View transaction list. I said view transaction list. Okay. Guess I didn't record that one. December 15th. Utility expense. What was it? 305? And the credit is going to be to what? To cash, right? When I paid that utility bill. Okay. And don't forget to hit record transaction. Okay. And again, when we look at the income statement, hopefully we'll see it correctly this time. There it is. Utility expense 305, right? And of course we paid cash for that. Okay. All right, so you come over, and we're getting there. Let's take a look at the next transaction in the general journal. And we are now going to view transaction list again. And we're getting to the end of this great exercise now, that we look at this number 16, and we pay cash for salaries. Okay, so, and we've seen other occurrences of paying the cash for salary. Debit salary expense, credit the cash. Okay, there's our credit to cash. And so we're going to debit salary expense, $700. We're going to credit the cash, $700. Okay, and it moves the cash to the left when I tell it it's a credit. And we go ahead and we record the entry. and we're all the way back to the first transaction, but we're good now. We run our trial balance. Now let's look at trial balance just to make sure nothing weird happened. Good, everything balances, and we're satisfied that now we have our income statement, revenues minus those expenses. That gives us our net income. We come over to the statement of retained earnings. There's the net income, beginning balance. We just started business here. Add the net income minus the dividend, ending balance and retained earnings. Balance sheet balances for all of those transactions. And the software does it automatically for us with a couple of snafus along the way, and that it shouldn't have happened. That I think was that accounts receivable. They didn't show it there for a second because they knew it was going to go away when we paid it off, and so it would have. They just didn't bother to put it here where it would have went from 1900 back down to 0. So they never bothered with it here for this academic version of a general ledger software. Okay, so that's a bit of a long assignment. I think what I'm going to do is do one more that's a little bit shorter for you, but I'll do that in a separate video, guys. So hopefully this was helpful to you, and we'll talk soon.